analysis of smart beta investment strategies in the emerging markets. So before I dive into the smart beta aspect of the paper, I want to talk a little bit about the emerging markets. The term emerging market is a fairly broad term that is used to describe countries who have taken significant steps to develop their economies, but are not quite yet considered developed. Examples of the nations include nations like China, India, Russia, and Mexico. During the 1980s, many of these countries began to actually embrace foreign investment in their countries. And foreign investors began to see the emerging markets as really incredible growth opportunities and an important tool for diversification. Since then, the emerging markets have become a staple asset allocation for investors and institutional investors. For many decades, institutions and high net worth individuals relied on professional fund managers to do the bulk of their investing. These active fund managers are oftentimes referred to as traditional managers because humans still have the final say over the selection of stocks to be included in their fund. In contrast, today there are many passive options that exist. Passive management refers to automated, electronically traded funds. Some would call them robo-funds. These passive funds are much cheaper than active management because they do not require the same costly oversight that active fund managers do. Traditionally, many passive funds have been set up to mimic market indexes, like the S&P 500. On average, passive investors have actually outperformed active managers over the last 20 years, and as a result, passive fund managers have been growing in popularity each year. But the biggest criticism towards passive funds is that essentially you're only going to be getting the market return, not necessarily the excess return that many active managers claim they can obtain. However, as passive funds have continued to evolve, this notion is starting to change. During the 2000s, a financial product called smart beta was developed. Rather than simply mimic a market index, smart beta strategies make trades automatically based on a variety of so-called factors. These factors can essentially be any type of quantitatively definable characteristic of a company or a stock. As these measures change with the availability of new information, the fund automatically makes trades and adjusts the portfolio. Essentially, this is what active managers have always done. So the introduction of this new financial product has made the investment space all the more competitive. As previously mentioned, traditional passive funds have beaten active managers on average, and this is because active managers tend to underperform than overperform the index. While this is also true for the emerging markets, human stock pickers are far more competitive in this asset allocation, and that is largely due to the informational inefficiencies that exist in emerging markets. So sophisticated investors can take advantage of these inefficiencies and have an easier time to find undervalued stocks in these markets. Smart beta strategies try to do this as well. Those smart beta strategies that only include exposure to emerging markets are fairly new, launching only in the past few years. Given the unique characteristics of the emerging markets and the exciting new possibilities of smart beta, this area of investing is highly interesting to me, and I decided to make it the focus of my research. The goal of my thesis was to take a close look at 5 of the major smart beta strategies and analyze their performance against the world's premier emerging market index fund, the MSCI Emerging Markets Index. By analyzing performance, I wanted to see whether these smart beta strategies have been outperforming the market, and I wanted to see how they compare to one another in terms of return and the factors that they trade on. I also wanted to see how closely their returns actually differ from the index, because the correlation between the index and the monthly returns of the smart beta strategies should tell us how much of a role the factors are actually playing, or whether their performance is simply being due to their exposure to the emerging markets and the factors are being largely relevant. This slide provides an overview of the 5 funds that I chose to look at. I decided on these 5 based on the criteria that they were classified as emerging market, that they were smart beta or multi-factor, that they had at least $100 million in assets under management, and that they have been trading since at least January 1st, 2016, which is the start of my time frame. This slide provides brief depth visual overviews of some of those factors those funds trade on. As you can see, some of these are simply accounting measurements like price to book and return on equity. So new information becomes available each day as different firms' quarterly reports go public. Other factors, such as volatility and momentum, are more technical in nature, and they're based off of the previous fluctuations in a stock's price. But the idea here is simply that factors can be anything that's quantitative, and each smart beta fund has their own algorithm for deciding the weight of each factor and the degree to which a factor must change in order to facilitate a trade. For my research, I pulled monthly historical return data for each of those 5 smart beta strategies and the MSCI Emerging Markets Index from January 1st, 2016 to January 1st, 2018. Adjusted close data is used to calculate return, and return is used over closing price for normalization purposes. This ensures that smart beta strategies are compared using the same comparable metric. The monthly return data is used to calculate monthly arithmetic mean and monthly geometric mean. But geometric mean is what's really important here because it considers the effect that compounding has on our investment over time. The variance, standard deviation, risk-adjusted return, and 2-year holding period return have also been calculated for each fund. For each smart beta strategy, regression analysis is used to compare the strategy's monthly return against the indexing data. The purpose of running these regressions is to see if the variance in return can reasonably be attributed to the factors or if they're largely irrelevant and it's really just the emerging market exposure that's having an influence on a stock's monthly return. So what were the results? Were the smart beta strategies outperforming the MSCI Emerging Markets Index? And the short answer is no, not really. This chart is a graph representation of what each month's return looked like for each smart beta strategy, as well as the index, which is somewhere in there. As you can tell visually, there is a lot of correlation between these funds. Here's a summary of the statistics. The two funds that outperformed over this 2-year period were PXH and FNDE. Both of these funds use cash flow as a factor, while the others do not. Additionally, FNDE only trades large cap stocks. On a risk-adjusted basis, JPEM was the highest performing fund because it had much less variation in its monthly return compared to the other funds. The results of the regression show that there is a clear, strong correlation among each smart beta fund and the index. The evidence for this is in the R-squared values. Of these 5 strategies, EMGF, JPEM, and GDM have extremely high R-squared values, over 90%. This means that over 90% of the variation in these smart beta strategies can be explained by the variation in the emerging markets index and the emerging markets overall by extension. PXH and FNDE, the two funds who displayed a higher geometric average, also displayed lower R-squared values, which is consistent with their outperformance. The high p-value of our model across all tests suggests that we have no reason to reject the null hypothesis, meaning that the funds are not statistically significantly different from the index. In summary, the two funds that outperformed had a few interesting features about them. Both of these funds used cash yield as a factor, while the others did not, and FNDE only looked at large cap stocks. These are both characteristic of what we think of in the US as being blue chip stocks, stocks that are large, well-known, and financially sound, but aren't necessarily set up for future growth. So think of a company like GE instead of Amazon. An investor looking to take more risk in the emerging markets is more likely to get a better return on these two funds at the top rather than the other 3, which have been virtual copies of the index. The most notable drawback to this research was the time frame. 2 years of data simply isn't an ideal time frame for comparison purposes, but since the funds are so new, with many only launching in 2015, it's the most time that we had to work with. Increasing the sample size would be able to give us a better picture of whether or not these funds are closely mimicking the index over a long period. Additionally, 2016 to 2018 was a period of fairly stable, moderate growth in the emerging markets, so including a time frame that had something like a global market downturn would be very useful to investors who are looking at the downside performance. Future research could also include a regression model that controls for each smart beta factor, or a regression analysis that compares smart beta directly to an aggregate of emerging market mutual funds, which will provide a direct comparison of human stock pickers versus smart beta. So there's a lot of directions that investors and researchers could go with this, but what I think is most crucial for investors going forward who have an emerging markets allocation is simply to getting something unique for your investment. And that isn't just going to be a vanilla copy of the index. A lot of funds claim to be smart beta or multi-factor, but it's really important to look at the returns themselves to make sure that the fund is actually taking some risk and that they're not just mimicking the index so they can actually get that excess return. Human stock pickers may underperform on average, but that's because they're trying to take these risks to try to get that excess return. So while smart beta funds are still in their infancy and the emerging markets are a confusing investment landscape to navigate, we do have some evidence that some of these electronically traded funds are starting to figure it out. So time will tell if this is another area of investing where robots will soon have the upper hand over their human counterparts. Thank you for your time. Thank you to my advisor for the past few months, Professor Ma. It's been wonderful in helping me get my research together and guide me through this. And at this time, I will now take any questions if I have time. Yes?
So prior to your research, were you expecting any of these smart beta funds to actually outperform the index, or were you kind of figuring that the index would still?
I was expecting them to at least outperform a little bit. Just based on the research that I've done, it seems that in the developed markets, smart beta strategies so far have been outperforming the index because these factors do tend to help find the better stocks overall. So I mean, the whole point of the factors is to try to find those healthier stocks, those undervalued stocks, automatically with new information. And in the developed markets, we do see that I think on average it's not a lot better. I think it's like 0.5% to 1% or so, but it seems like over the past like 5 or 6 years that they've really become well known. They have been outperforming. So I was expecting this to carry over to the emerging markets a little bit. Like I said, there were those 2 funds that were outperforming a lot, and it's interesting the kind of factors that they were using. And I think cash yield especially kind of shows what's important to the emerging markets right now. So they're looking at the emerging markets. The whole point of them is that they're growing right now. So instead of looking for a growth stock in a growing country, you're just looking for financially sound, well-known, well-developed companies, and those will naturally grow if the emerging market is growing, which by definition it should be. So, yes?
I guess I just want to make sure I understand how this works. So there's these factors, so do they trigger trades?
Yeah.
So if you have a certain, I guess, cash flow or something, there's a certain change in the cash flow, that would just trigger.
Exactly, yeah. So they have an algorithm that looks at this universe of stocks, and so for the emerging markets, they would have just a list of thousands of stocks, and every single day, new data is being pumped into the market when different reports go public, when different news reports show different things happening at different companies, and this is all being translated into ways that computers can read. So if there's bad news about a company or good news about a company, it's being translated for computers, and they can put that into their model, and then if they see something happens where the company had a really good quarter, it would know automatically. And then, like I said, I don't know exactly what the weighting scheme of each fund is because that's confidential, but you can assume that that fund is going to make that trade when that information becomes available, and it's going to do it a lot quicker than a human.
It's sort of like active and passive. You're an active trading, but it's sort of
right. So it's like a hybrid. It's in between there. So I mean, originally you would think of passive funds as just being these like ones that just mimic the market, but now you're starting to see this in between, like the robots who are doing what active managers traditionally prided themselves on being able to do. So that's kind of the idea there. It's kind of why it's interesting because it makes you wonder how long do these active managers really have before they're just being very consistently outperformed by the robots. So,
if there's time for more questions at the end, you're welcome to ask them. At this point, thank you, Alex.